Good morning. Welcome to Flyers Real Estate Direct Private Debt Forum, Part 5. This is our fifth event in the series. Part 6 will be September 10th. It'll be a one-day event. If there is demand, we will move the event to a two-day event. If you'd like more information regarding the Part 6 event, please go to flaia.org. Under upcoming events, and the part 6 will be listed there. We had a great day yesterday. Thank you for joining us today. We would like to thank our sponsors, Nationwide, Allagash Partners, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, and Clarion Asset Management for making the event possible. Also, we'd like to thank all of our Flyer board members for their support during these times. For those of you that are not familiar with Flyer, Flyer is a 501c6 nonprofit organization that was started in 2007. And the goal back then and the goal today is to make Flyer the world's leading marketplace for alternative investments and alternative investment education. Since that time, Flyer has helped thousands of firms in the capital raising process, aided in the allocation of billions of dollars to alternative investments, and we've leveraged technology to accelerate the DD process. Today, Flyer has over 1,000 members with over $1 trillion in discretionary AUM. And before we get to our next speaker, I just want to mention that we have webcasts coming up next week. The first one is by Nationwide, and the webcast will be around their income ETF, NUSI, ticker NUSI. That's July 22nd at 1 p.m. And we'll also have on that day Lloyd Jones. In the topic will be investing in senior housing. That's also at 1 p.m. Without further ado, I'd like to thank you for attending. And our first presenter today is Mr. Jesse Fahey, VP Private Capital Funds, Preqin. Jesse?
Great, thank you, Rain, and good morning, everyone. As mentioned, my name is Jesse Fay, and I serve as the Vice President of Private Capital in the Americas for Preqin. Within that role, I'm in charge of data collection and quality, as well as thought leadership such as this. Throughout the presentation today, I encourage you to take advantage of Zoom using the Q&A feature at the bottom of your screen. I'll be monitoring your responses throughout the presentation, and will do my best to answer them all at the end. For repeat listeners, this is my fifth and final presentation in the Flyer series, looking at the performance of the private real estate and debt markets through COVID-19. The midway point of the year gives us a good measuring stick to review how the asset classes have fared during the pandemic and where we might see things heading in the remainder of the year. For anyone who's not familiar, Preqin is the leading provider for alternative assets data globally. Across each asset class, we cover fundraising, performance, deal activity, and investor sentiment. Today, I'll be delivering an asset class update for private debt and private equity real estate, showing how the asset classes have fared this decade, as well as their performance through the onset of COVID-19. But first up, we have private debt. Tracking the growth of the private debt industry from just before the global financial crisis to today shows the tremendous growth in size that has taken place over the past decade. In many ways, the GFC served as a launching point for the private debt industry as we know it, with regulations forcing banks to deleverage their balance sheets and alternative loan providers stepping up to fill the void. Fast forward 10 years, and the asset class has over $858 billion in AUM and looks poised to cross the $1 trillion mark in assets at some point in the next year, as the asset class has become a favorable choice for LPs planning for the end of the last bull cycle. One interesting takeaway from this is that dry powder actually fell over the course of 2019, despite adding over $100 billion in AUM. As we will see shortly, however, managers have been working hard to fundraise and replenish their dry powder levels, something crucial as recessionary vintages tend to outperform their peers. Dropping back to the early aughts, we can see the birth of the private debt industry, which was mostly non-existent prior to the GFC, but had great growth through the 2010s. Private debt managed to eclipse its pre-recession fundraising highs in 2015, en route to 5 consecutive years of $100 billion fundraising, spread out amongst a good mix of managers each year. That acceleration in fundraising has plateaued a bit, however, following the past 2 years after peaking in 2017. And while you would expect fundraising to collapse during the pandemic, numbers are largely on pace with where we were during the same point last year. Larger managers with strong established relationships with existing LPs will be able to raise funds, while managers without that luxury will need to wait for restrictions to ease so they can begin to win the trust of more cautious LPs. This further exacerbates a decade-long trend toward capital concentration, although average fund sizes are still nowhere near the size they were before and during the GFC. The impressive fundraising performance comes despite some rather lackluster distribution figures from private debt managers. Unlike most private capital asset classes, net cash flows for LPs from their private debt portfolio has been flat or negative for most of the past decade, with capital calls coming faster than debt managers can return capital. That was even more apparent last year as net cash flow fell to its lowest level since 2008. But this is not due to lack of performance. Rather, private debt is a victim of its own fundraising success, scaling at such a rapid rate that managers are calling for capital for new funds before they're able to exit and return capital to investors. That speaks to the great confidence that LPs have in the asset class, that they are willing to keep allocating large chunks of capital before their initial investments are realized. Overall, dry powder is at a healthy level, rebounding from the 2019 dip to hit a new record high in June of this year. I've said already how the GFC signaled a launching point for private debt. What would be more accurate to say is that the 2010s saw the rise of direct lending as the dominant strategy within the asset class. Direct lending was basically non-existent and now comprises nearly half of all AUM within the asset class. One area that's proportionally worse off than it was leading into GFC is distressed debt, which has only $50 billion in dry powder, despite all the cash that's flooded into the asset class over the years. While one would expect distressed debt to thrive in the late cycle and early recession years, that hasn't been the case so far, as dry powder levels today are at the lowest level since 2015. Before we take a look at the performance figures, let's examine what LPs tend to seek when they invest in private debt. Diversification is the #1 reason they allocate to the asset class, which is no surprise within alternatives. Unique to private debt, however, investors expect high risk-adjusted returns to go along with a reliable income stream when they allocate to private debt managers. When it comes to reliable income streams, that's something that private debt has largely delivered on, with very steady returns throughout vintages this decade. The median net IRR for most debt strategies has hovered right around the 10% mark across vintages, give or take a couple of percentage points depending on the year. Venture debt serves as an outlier overall, and special sits funds saw a year of outperformance directly after the GFC, but for the most part, the asset class's consistency has been outstanding. Looking at the asset class from a risk-return basis, we can see a wide spread depending on which private debt strategy you choose. Direct lending is by far the most popular strategy these days, and that makes sense when looking at this graph, since it provides remarkably steady returns, even if it is the low man totem pole in terms of returns. The one clear outlier here is also the smallest by AUM. Venture debt has outperformed similar strategies by more than 2 percentage points, while also scoring the lowest overall risk profile within the asset class. As a whole, private debt performed well through the last recession, recovering lost value by early 2010, much quicker than our benchmark for the wider private capital universe did. That helps deliver on the second reason why LPs target private debt for their portfolios, which is the high risk-adjusted returns they believe it can deliver on. On the longer timescale, however, high absolute returns from private equity managed to outpace the overall steadier returns from private debt, highlighting the importance of proper diversification as the overall private capital index delivered better returns over this long time horizon. However, recent strong fundraising by private debt managers shows that LPs clearly believe in the asset class to perform well through another economic downturn. And the fundraising has been strong too. In fact, when looking at just H1 figures, 2020 has been the second best year on record for private debt overall. The fact that LPs have not slowed down their investments to private debt, but in fact have accelerated it, even with the awkward roadblocks thrown up by social distancing measures, shows the great confidence that investors have in debt during a downturn. I touted before how private debt was well on its way to a strong fundraising year despite COVID-19, but that actually might be underselling the situation. Private debt fundraising has actually greatly accelerated in Q2 versus Q1 of this year, meaning that not only is private debt having one of its strongest capital raising years yet, but that seems to be fueled by the outbreak rather than hindered. It remains to be seen if this momentum will continue, but it is clear that investors view private debt as a safe haven when markets go south. In terms of what strategies are raising, there's been a clear increase in interest for distressed strategies, meaning distressed debt as well as special sits. Together, those strategies have raised more than $26 billion so far this year, as investors anticipate a drop in asset prices. Direct lending is still the most popular overall, the most popular strategy overall, however, raising just under $25 billion on the year and continuing as the dominant strategy amongst private debt. With that said, capital concentration has been a trend across all alternatives, and the pandemic looks like it's only making it more pronounced for private debt. Since the start of the decade, funds raising $1 billion or more have been capturing larger and larger shares of the overall annual fundraising each year. So far this year, the difference is the most stark we have seen, with 71% of all capital raised going to funds at or above $1 billion, and 44% going to funds that have managed to raise over $2.5 billion. Managers seem to be seeing an opportunity as well, with more than $40 billion targeted by funds in market today than what we had seen at the start of the year. The GFC served as a great opportunity for private debt managers, so many are looking opportunistically at the current situation, thinking it can afford them similar opportunities for investment and growth. Among those who are launching new funds, distressed debt is a particularly popular strategy, with the number of new funds in market up 33% from what we were seeing at the start of the year. But direct lending remains the dominant strategy, with 242 funds seeking to raise more than $112 billion between them. That is up nearly a quarter since the beginning of the year, showing a lot of confidence behind a strategy that already holds such a large market share of private debt assets. Fundraising has been outstanding with all things considered, but deal activity is an area in which we are really seeing the pandemic show up in the data. Deal activity has been pretty strong in recent years, eclipsing 1,000 deals 6 years in a row and $75 billion in debt size for the last 5 years. As you can see, 2020 is well behind the pace from those years in both volume and aggregate debt size. The year started off relatively well, with strong aggregate values on the financing, although total volume lagged behind the monthly averages from the past 4 years. The last 3 months have really highlighted the decline in volume at a count of 50% less than average in April and May, although June serves as an outlier with a very strong performance by both value and volume. But similar to the fundraising market, it was up to several large deals or funds to generate all the capital, as volume still trailed behind Q1 totals. And basically every industry has suffered, the June bump notwithstanding. Of it all, healthcare and information technology have held up the best compared to other industries, but those are still relatively depressed, although we're only halfway through. July is, though we're only halfway through, July is on pace to be the weakest month yet, with just over 20 deals done to date. By geography, the US has seen the biggest proportional hit compared to other regions. This is likely due to the dominance of US private debt-backed deals over the past decade, but clearly pain for the pandemic is being felt, as well as a general maturing of markets in Europe and Asia. So in summary, private debt has felt the effects of COVID-19, but it hasn't all been negative for the asset class. First, there's a very real chance that private debt could surpass the $1 trillion mark this year for AUM, a very significant milestone for such a young asset class. Further, within that AUM figure sits quite a large amount of dry powder. Private debt funds today hold more dry powder than all the AUM for private debt combined during the GFC. Returns have been solid and steady throughout the entirety of the past decade, performing exceptionally well during the GFC and delivering on that reliable income stream that LPs love and target the asset class for. Fundraising has actually improved this year, with H1 numbers surpassing the previous year and being the second strongest first half for private debt on record. In particular, distressed funds have been doing well, leading the way for fundraising the past couple of months and seeing a big increase in new fund launches through the pandemic. However, deal activity has slowed, and even with some large deals still taking place, volume is way down, and despite a strong June, it seems like it'll be a while before we see a full recovery. Okay, now let's look into private real estate, which has not fared as well in recent months. Despite a terrible start with the Great Recession and mortgage crisis, the 2010s ended up being a great period for private real estate, going from roughly $400 billion in AUM at the start of the decade to surpassing $1 trillion as of the end of last year. Of that, more than $1 trillion in AUM, a third of it sits in dry powder, ready to be invested towards any dip in asset prices. And given that the recession was close to a worst case scenario for real estate, I'm sure that managers are eager to deploy their dry powder this time around. That huge growth in AUM and healthy dry powder figure is in large part due to the impressive fundraising over the past few years. Fundraising has been incredibly strong, clearing $100 billion in capital raised in each of the past 7 years, with 2019 being the best year yet with a record $170 billion raised. It took a while, but the asset class has been raising capital at pre-recession levels since 2015, along with a healthy number of funds closed each year. While 2019 brought us a record in capital raised, it was across nearly 100 fewer funds than the previous year, following the same pattern of capital concentration and larger average fund sizes that we noted in the private debt overview. 2020 obviously will not keep the same fundraising momentum going. However, it is still on track to surpass the $100 million mark, or $100 billion mark, albeit on what might be the fewest funds closed since the start of the decade. Despite recent years of strong fundraising, dry powder has actually fallen year to date, falling back below the $350 billion mark. Overall dry powder figures are still much better than what it was leading up to the GFC, however. Chief among those are the opportunistic funds, which currently hold $129 billion in dry powder, more than any other private real estate strategy. During the GFC, opportunistic strategies also saw the greatest amount of fundraising within the asset class, so that large pool of dry powder could see itself increase as the year continues. Distressed funds represent the smallest pool of capital, so an uptick in fundraising there would likely be necessary if a large amount of distressed opportunities begin to open up. The recent strong run of fundraising years makes a lot of sense when looking at the influx of cash LPs have been receiving from their real estate investments. From 2013 onwards, LPs have been net cash flow positive every year, with distributions in excess of $250 billion between 2015 and 2019, peaking with a net capital of nearly $100 billion in 2016. Since then, distributions have lagged as capital calls have climbed higher, leading to net cash flows closer to zero in 2018. However, that was followed by a record fundraising year in 2019, so clearly LP's attraction to real estate lies beyond simple net cash flow, and that figure ticked back upwards in 2019, extending the streak to 7 years of positive distributions. But what exactly is it that LPs are targeting when they invest in real estate? Of course, diversification is at the top of the list, but in addition to general diversification is a low correlation to the other alternative asset classes. Similar to private debt strategies, investors are also looking for a reliable income stream to go along with an inflation hedge in their portfolio, making real estate a great defensive investment for institutional investors. Across almost every vintage and strategy, real estate funds have delivered IRRs in the low to mid-teens, along with a few outstanding vintages of outperformance from value-added, opportunistic, and distressed fund strategies. Debt strategies have been lagging slightly, but what it hasn't given in raw IRR is made up for in consistency, right around 10% for each vintage since the GFC. Looking on a longer time scale, you can see that consistency matters. Real estate debt strategies were the most insulated during the GFC, so investors in the strategy were able to recoup their losses first. That initial downside protection, coupled with solid returns and a very low standard deviation across funds in the benchmark, means that debt as a strategy has outperformed the rest of real estate on the recession timeline. And this is after a recession which decimated real estate returns, with the wider real estate benchmark not recovering until 2016. COVID-19 should be much less catastrophic for real estate investments, and while there are certainly concerns in certain segments and geographies, like top-tier cities, that will only open up opportunities for other managers. Next, let's look at real estate by their various risk-return profiles across different strategies, as well as their relative size by AUM. By that view alone, distressed managers seemed clearly to be underallocated, delivering the second highest median net IRR with the overall lowest standard deviation across selected vintages. Size of the bubble in this graph represents relative AUM. So despite being an outlier due to the strategy's outperformance, these funds only represent $36 billion in AUM. Beyond distress, however, we see a nice dispersion of returns versus accepted risk with a fairly linear progression of higher IRR against standard deviation of IRR, allowing LPs to pick and choose their investments based on their risk appetite. Looking at the first half of this year versus past years, we are down from the record years of 2018 and 2019. But though we won't be breaking any records this year, fund managers are still managing to raise large amounts of capital with the fourth best H1 this decade. That capital is flowing to fewer and fewer managers as the fewest number of funds closed this half since 2010, and average fund size is up to $618 billion, which is the highest on record. That trend is becoming more and more pronounced as the months progress. Aggregate capital raise has remained fairly steady month over month this year, but the number of funds closed has been falling steadily. LPs just don't feel comfortable allocating to an unproven manager through a crisis. So those with an established track record are able to capture the lion's share of all capital inflows. And like with debt, that follows a decades-long trend. Year over year, funds that raise $1 billion or more have been capturing a greater proportion of allocations, with nearly 2/3 of all capital inflows the past 2 years running. In addition to lowering net cash flows, we've also seen our first contraction in funds and market in 8 years. The dip between January and today is relatively small, but still very notable as the growth in numbers of fund and market has been incredibly strong since the asset class stabilized following the GFC. I use this as a barometer for fund manager optimism. So lack of any new fund launches shows how difficult it is to bring any investors in during COVID-19. A recent poll Preqin conducted has the majority of respondents feeling that we would not see a normal fundraising environment until the first half of next year. So real estate managers considering a fund launch may be biding their time until then. The private real estate deal market has been on fire coming into the year, with almost 10,000 deals in both 2018 and 2019 to go along with 3 consecutive years of aggregate deal values in excess of $400 billion. Though we are only in June, the drop-off compared to the past 3 years has been stark, and deal making is clearly stopped in the wake of COVID-19 and social distancing. Looking at a breakdown of deal volume by property type, office and residential unsurprisingly lead the way, comprising just over half of all deals taking place each year this decade. Residential remains a large portion of the deals taking place each year, but the progression from the start of the decade to now has seen it become de-emphasized from around 30% in the early decade to just 23% last year, and taking a backseat to office properties for most deal volume. Perhaps the most notable property type by its growth and significance has been for industrial properties, going from a relatively small slice of total volume to 16% of last year. On the other end of the spectrum, hotel deals have been absolutely pummeled this year, barely registering on this graph as the travel and hospitality industry suffers under social distancing rules. Month over month, deal activity has plummeted, with May and June seeing just half the volume and a third of the value that the same months in 2016 and 2019 have given us. July is halfway through, but it looks to be on pace for one of the worst months yet, as recovery in the US has been stalled by virus spikes in many key states, and the world wonders when a return to normalcy might happen. Highlighting 2020 and looking at volume by month really shows the huge effect that COVID-19 has had on deal making. After a relatively strong start to the year, volume has fallen every subsequent month, with the 314 deals recorded in May being the lowest total for a month since 2013. Though only halfway through the month, July is on pace to be even quieter, with only 113 deals recorded thus far, compared with 827 in July of last year. We had conducted a survey in April asking which industries and strategies investors were targeting and avoiding across all alternative assets as a result of COVID-19. The number one response for what investors were avoiding was retail-focused real estate, with 34% of all respondents highlighting that as a strategy to avoid. Piling on retail has been something of a theme this decade, but deal volume so far this year supports it, and I don't foresee it changing anytime soon. As for what investors were targeting, logistics and data centers were highlighted as an attractive property types, which tracks in the deal volume so far this year, as industrial property types have been somewhat resilient, at least in comparison to the other asset types. So in summary, real estate has crossed the $1 trillion mark in AUM, becoming the third alternative asset class to reach that milestone. That is in large part due to the great liquidity that the asset class has offered its investors, returning a net of $350 billion to investors since 2013. By both strategy and property type, there's a nice spread of risk-return profiles for LPs to invest in, allowing them to achieve the highly diversified portfolios they seek. The outlier within that spread has been distressed for real estate strategies, which has offered the second best returns with the lowest risk among any private real estate strategies. Despite the current scenario, 2019 was a banner year for private real estate with a record level of fundraising, as well as near records for deal volume and value on the year. That's taken a sharp turn for the worse in 2020, as fundraising is down over 20% from where we were last year, and overall dry powder levels has seen a rare decline. The drop in deal volume is even more severe, with every subsequent month seeing lower totals than the previous one during this pandemic. The silver lining in there is that industrial property types have been somewhat resistant to the pandemic after showing tremendous growth over the course of the 2010s. Within those, logistics and data centers have been listed by investors as property types that they're specifically targeting within their real estate investments. Thank you everyone for listening. I hope you enjoyed the presentation. If you'd like a copy of the deck used today, you can reach me at the email currently on the screen, and I'd be happy to provide you with a link where you could download it from. I know we ran a bit long. Michael, do you have any time for questions, or do you need to move on to the next session?
I need to move on to the next session. However, I will send you a list of the questions with the contact information so you can reach out to the people directly.
Okay, great. Thanks, Michael, and thank you everyone again.
Sorry we started a little bit late today, Jesse, but thank you very much. Thank you to Preqin for being a member of our group and to sponsor the series. We really appreciate you guys.